FOMO rallies, debt ceilings, and how to leverage poor auction structure. That is the focus of this week's weekly outlook of markets and profile from the team here at TRADEWITHPROFILE.com as part of our profile trading development pathway for the week of January 22nd, 2023. Hey everybody, I'm Josh, the founder of Trade with Profile. We're a skill development firm helping developing traders, specifically those that are looking to be active intraday in products like the S&P, the NASDAQ, the Russell, or crude oil futures, build a playbook using the profile as a way to organize market information and then express that in a repeatable, consistent way so that the ultimate objective is to get that equity curve up and to the right. So this is a video that we're going to spend the next 30 minutes or so looking at what's coming in the week ahead. This is part of how do you get on that path, is understanding the auction, understanding the likely destinations of the auction based on what's happening in that, and having an idea of what potential catalyst may accelerate what you believe in the narrative or counter it so that you're coming in each day with a plan and a purpose. So with that, we're going to dive right in. And we're going to start where we typically start, and that is just kind of reminding ourselves of what the macro story is as we are in the larger beginnings of the year. And the place that I want to start is right here. This is looking at the VIX curve relative to the SPY. So the S&P so far has defended and we're trading inside of 2022 prices. We're moving toward a couple key references that I want to point out. So these two are anchored VWAPs from 2022 and 2021. This is the anchored VWAP from the COVID low. What does this essentially tell us? It basically says, hey, anybody who's been active since COVID is above the average price. So price is above that the full volume weighted average price since those events, but we're below the average price for 21 and 22. Currently, this is the VWAP for this year, the developing one 2023, and you can see last year's low is back here. Now, below we have the VIX structure, which is evolving, but giving us still really good insight in terms of where people are positioned. And the reason that we look at this each week is simply because, from a foundational principle, markets rally when everyone is fearful. So when you're at max fear, that's when markets rally. And when you're at max complacency, that's when markets fall. And the question is, well, how do you measure complacency? And the way that we've done that historically is to look at how do people position around risk. Are they underpricing risk or are they overpricing risk? So how you would be overpricing risk is like if you're buying puts to protect as you've really sold off, it's really too late, right? You want to be buying protection when you don't need it, not when you have to have it. And so this is a measurement because the VIX, which is kind of a 30-day window out that shows us how are people increasing expectations of volatility in the S&P complex over a 30-day window. Well, there's other expirations of VIX. There's 9-day VIX, the 30-day VIX, 3-month, 6-month, 1 year, and so forth. And so we can look at the relationships of these different expirations. What has been a key takeaway from 2022 that still continues in 23 is that the distribution of participation across the curve is getting really, really tight to the front end, meaning that almost all of the participation is taking place in that 9-day window. People who are participating in longer windows in the past didn't get paid for those hedges. And so now what they're doing is they're basically grabbing for protection on the, basically the day before that they need it. And then, it's gone from there. The other dynamic that's in play is that because we had a, pretty sizable down market last year, is that there is this concern of missing out on rallies. So, regardless of whatever the macro story is, which inflation is still the macro story, interest rates being increased is still the macro story. And those are all expectations, right? We're still expecting the Fed to keep raising rates. We're still expecting inflation to be a problem. However, everybody's, when everyone's bearish, which has kind of been the narrative, there's expectations of like, hey, do we rally? And we definitely saw that to begin the year. We've continued that. What we saw on Friday, which was OPEX, which was something we were looking at last week, is that we saw a massive amount of call buying. So there's both put selling and call buying taking place on Friday, and it was all in options that were expiring that day. which actually increases the VIX. So you'll actually see that the VIX curve actually got a little more what we call fearful on Friday. However, almost all the participation was in calls, not puts. So there's a little bit of a cloudiness in here. And this is why we don't look at this at just one expiration, but look at this across most of them. Overall, the story is that there's not a strong conviction one way or the other. We try to look at this curve when we get to one extreme or the other as a pretty good tell of what we're looking to do. So, for example, back here in October, we had a really good inversion that led to a nice rally when everybody was fearful across the curve. Right now, it's very muted, definitely more on the complacent side than it is anywhere fearful. So we're going to keep monitoring that, especially as we continue through earnings season and we start angling toward the first FOMC meeting that will come up next week, and then subsequent meetings in March and so forth. So that still the dynamic, still what's going on in play, and something we want to be mindful of, that it just is not real clear because there's a lot of fight for position around this as we begin the year. So that's some of the macro story and narrative that we're carrying forward. So next would be, let's just dial in here and look at what potential catalysts could influence that story in the week ahead. And so we're going to go over here and take a look at the calendar and see what we've got to pay attention to in that story. Here we are at the calendar. To start the week, we've got some ECB information that's going to come out. Not policy statements, more like speeches. So that could be interesting, something to just pay attention to. That will happen overnight. We do have on Tuesday a cluster of releases in the middle of the open to be attention of. Anytime I see a release that's in the middle when they're stacked like that, that will likely move. How that can impact you is if you're in position in that first half hour and something goes crazy, like if you don't know where that is, it can really shake you out and make you think that there's something that's happened that you don't know. If you just know that that's going to be a release, hey, you're in good shape. 2-year note auction on Tuesday. Watch that during lunch. Wednesday, we're back to our typical schedule of crude oil inventories. And then Thursday, we've got GDP. So we got the first read on GDP for the year. That's going to be significant to watch. And then on Friday, we've got some inflation-related information both before the open and then after B period that will likely give us some decent movement. So those are some of the bigger things to look. Other things that are in play this week that will be in discussion is the debt ceiling. So the U.S. has essentially hit its debt ceiling, and now it's all a fight about whether or not we will raise that debt ceiling. This has been a consistent narrative, and you'll see news reports that will say, oh, well, if we don't raise the debt ceiling, then it'll be catastrophic. I've lost count of the number of times in my career around markets where we've talked about and hit the debt ceiling, and we always raise it. It does become a political thing. They've got till June really to work on this, so it'll be kind of there. But really, the market doesn't really care. So don't take action based on narrative around the debt ceiling. Let the auction positioning really be your guide. It is my perspective on that, and how I'll be positioning around that. The other thing that's kind of key this week is we do have some pretty healthy tech earnings to watch out for. So we have Microsoft after the bell on Tuesday, and then we have Tesla after the bell on Wednesday. So those will both be pretty good movers and could likely lead to the auction kind of pausing and slowing down heading into those releases, and then getting most of the movement after. So if you get frustrated on Tuesday or Wednesday as we're waiting for those releases, that's just the nature of earnings season and something we got to work through. Okay. So that's what we're looking for on the calendar. Let's start looking at the specific products and get a sense for what we got in the week ahead. So we're going to start here by jumping over to the ES and going to get to the long-term chart first. We're going to look at this on a monthly basis, basically monthly profiles, and then kind of drill down from one to the next. Last week we came in, fairly bullish, and as long as we kind of held the 39.89 area, opportunity to push higher. We did see a pretty big push lower off of VIX expiration, so there's a big expiration in VIX futures that occurred on Wednesday that took us back essentially to the monthly VWAP or the VWAP of the year. And then Friday, we get this massive ramp right back here. Overall, if I'm looking at the profile for the month so far, I mean, definitely inside of last month. Right, we're inside of last month's ranges. We're above pretty key node here at 39.89. Nice move, pullback. So this is pretty key that we keep defending this area. There's a couple different brackets that we've been defending, and this has kicked us back into the higher one. So as long as we're in this higher area, we still have the opportunity to push towards last year's VWAP and higher. Should we reject here, we're going to go back in this direction. So keep an eye very carefully still on that 3,900 to 3,930 area as we get in. Let's look at the 2-hour chart, get a little bit more of a perspective here as this is not completely updated to the most recent data. Let's just clear the data and see if we can get this thing to rewrite. Because on Friday, what we essentially did is we traded all the way back. You can see back up here to 39.88 after pushing lower on the VWAP early in the week. And so that really puts us in a place now where we recovered. We've largely held the higher prices, and and now we're looking for some continuation. That being said, as we look at, we'll just jump over here to the quick sheet as we're waiting for. Let's get this thing loaded here. We've got 40.13 as the key pivot for the week, 38.45 to the downside. Weekly expected high, 40.91. Weekly expected low, 38.85. So we could totally get back into that lower range, potentially. We'll have to kind of see where we are. And this is a part of this product. There we go. See if, oh, perfect. All right, awesome. We're ready to rock and roll there. So last week, VPOC here, we traded below it, really opened up vulnerability to the downside. We came on to OPEX, and that was when we had that massive call buying that pushed us higher and pushed us right back here to the new 90-day. We've got last week's VPOC up here. There was selling that came in off of the BOJ and the VIXpiration. That's still relatively in control. So we really need to kind of trade through that to challenge it. As long as we stay below that, we can roll back in. We could essentially just build value in this area because we still need to migrate the 20-day, right? So a couple ways we can do that. We either trade back up here and spend time, or we roll down and go in this direction. We could also kind of meet in the middle right around 39.20. So that's why I like having these larger composites out to the right, because it kind of gives me an idea. Now, one other thing that I want to point out as we start the week is looking at the profile from Friday. Okay, so multiple distribution trend day and lots of singles. So singles, 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 singles. So 1, 2, 3, 5 zones of singles in one session. This is what we call poor structure. We're going to talk more about that in the balance of the video. But essentially note that where we closed and where the most traded price for the day is way down here. In fact, if you look at the full composite for the session, that volume point of control is way down here. Like we didn't even move it higher. So this is very shaky. Be very open to the possibility that we trade all the way back into this range significantly on Monday or Tuesday before heading higher. In fact, if we move higher first, I'd be very concerned because there's just nothing here. Very impulsive, and impulsive structure carried forward is very weak. So I won't be looking for anything long unless I can start to clean up and revalidate some of this stuff before we start pushing higher. If we open immediately higher, get back in range, look for them to start cleaning up some of these before they try to turn back in that direction. So they're really, really poor structure as part of OPEX. But to the upside, 40.13 is the clear magnet. And then 40.20, as far as the weekly expected high, that gets us up here to like that 40.90 area. And then, to the downside, we're back down here around 38.88, right back in here. So that gives us an idea of, what we're looking for in expected range for the week in the ES. So definitely Monday, expecting some rotation, some digestion, kind of in this area. could pull back as far back as here, really could happen. And then, see if that entices buyers, or if on an initial push higher, we rotate back and try to spend some more time around 4013 to pull the 20-day higher, would be the expectation. As far as the week goes, and what we're looking for, as long as we can stay, I really think kind of north of 3960, I think we're pushing towards 4100, and further confirmed if we get above 4015. If we retrace back through this area on Friday, then I'm looking for 3860. So it's pretty clean. Going to be kind of murky in between here. More confident above here, less confident below there. That's the expectation. When we're in what we call kind of a ping pong posture, we're below the 5-day and above the 20-day, we're in the middle. So you're either going to go to one or the other in an attempt to try to pull those together. Okay, so that's what we're looking for in the ES. Let's go talk now about the NASDAQ and see if we've got data loaded here that is ready to rock and roll, and it appears that it is. Okay, we'll just start here on. Well, we'll look at the monthly if it's drawn. It does not appear to be. We will jump over here and look at the quick sheet real quick. Equal to the 5-day, essentially, 11,600. We were 77 points above that, so we actually pulled the 5-day lower and above the 20-day, looking at about 138 points in the first hour still, 175 for the day, and about 393 for the week is what we're looking at. Okay, where are we on a monthly basis? Well, we're right back to the most traded price of essentially the year. We got and tagged the most traded price of last year, and then we recovered back to it by the close. Ultimately, we're still in a large range here, and we do not have a good low. Still at some point expecting that to be tested this year. When that happens, not sure. You can see the 20-day is down here. The 5-day is here, and price is above that. So, we pushed too much higher, and we will be in what I call an extreme posture, which makes this pretty vulnerable. We can see this a little bit better when we go look at the 2-hour, and you'll notice how this profile here is very thin. So the higher we go, like let's say we go straight up here, which totally within the essentially the trending channels as far as like monthly VWAP, right? Here's monthly VWAP down here. Could easily push us up in this direction. In fact, weekly expected highs are, up in that neighborhood. Just like the ES, as long as we kind of hold 11,440-ish, expecting pushes towards, 12K. Below that though, we would revisit the area of monthly VWAP and then push back towards the 20-day. A couple other things of note. So this VWAP here and this one here. So this is the last CPI reading. This is from non-farm payrolls. So, we've been essentially kick-saved those two prices and those two events as we're moving higher. Again, we do have Tesla and Microsoft reporting. So, I would typically expect earlier pushes as we get towards those, and then see if there's failure that comes in later in the week. Same story, however, as we had in the ES. Look at how nasty this profile is. A really good strong profile is very Gaussian. You have you're kind of checking between prices. This is very punchy. Lots of singles in here. Expecting that to be cleaned up. If we open in range on Monday, I would look for tests all the way down here before we push higher. If we open above and get back inside the range, it'll be cleanup city. So we could push a lot deeper into that trade than we would typically do, given where we're at. All right, and given how the structure is, and that the structure and the drive higher on Friday was largely driven by options that expired. So with those options gone, we don't really need futures to support those anymore. So often the auction will correct as that inventory is corrected, is not needed by the market makers. All right. So that's what we're looking for in the NASDAQ. Let's get over to the Russell and see what we've got going on in that product. Get over here to the quick sheet, and we've got ping pong posture between the 5-day and the 20-day. Ended at 1875. Last week we were in extreme posture when we came into the week, and we were looking for move basically back to 1855, which is what we got. That was kind of our key idea in the Russell. We at first did a little bit of balance, and then right back to that 1855 area, did save that. Now, not quite as strong a rally in the Russell as in the ES and the NASDAQ. We still have sellers from back here that are in control. We are also in between two references. I would expect that we're going to see one of these two prices this week, given the strength of Friday's rally. Unless we take that out, the path of least resistance would be up here toward the 5-day at 1894, and then look for a push toward new weekly highs and challenge this excess, really kind of on the way towards a 1930 area. Again, if we fail here, then we're going to be going back and revisiting basically the 1800 area in terms of an expectation. And we can see that even in what's offered in terms of the options of 1917 to the upside, 1834 to the downside. So key reference to be watching is going to be that 1894 area. All right. So 1894, last week's VPOC right there is going to be key. We're going to start below that. We also have to the downside 1847. Could be choppy in between those prices. Above 1895, we can push towards new weekly highs. Below, and then we're revisiting the monthly VWAP on a way towards 1810. So be very careful in here. We're kind of in a VWAP pinch between weekly and monthly VWAP. But above this here, which then could, if accepted, push in this direction. Below here, could push in this direction. Largely leaning first on buyers because we had the strong trend day on Friday. So expect, continuation higher. And we've got some poor structure to clean up as we've created poor structure. So, it's kind of one of those, like if I can open here, get and test and find buyers and see if I can push in this direction, that would be a really good and clean auction as long as I'm above the opening range of Friday. Would be helpful. Let's go look at the monthly chart just real quick here. Very much in the middle of the muddle. We are holding the year-to-date VWAP. We're approaching last year's VWAP as well. Ultimately in the middle of a larger bracket that's essentially from 1750 up to 1920. So until we get out of that, this is the playground for the Russell, and we're going to keep playing towards those edges depending on how we're holding specific references. Okay, so looks pretty good for the Russell as long as they can kind of hold 1846. But below that, we open ourselves back up towards the bottom of the bracket. Let's talk about crude, shall we? Crude oil, the other white meat. We'll start here by looking at the quick sheet and look at the posture and see where we're at there. Bullish posture above the 5-day, which is equal to the 20-day. 80-50 is going to be key. Now, note here, we're significantly above the monthly VWAP. And, I'll tell you what that means in terms of, how we look at that once the data loads here. But so here's the monthly profiles, and, here's the year-to-date, which, because we're in January, is also the monthly VWAP right here. We're about 4% above that. We are in a balancing range. We're above the open of the year. We are also, tested and came back and held the price that we really needed to keep holding. So really, as long as we keep holding the 20-day and the 5-day down here, really expecting to make new monthly highs and push in this direction towards $85, $86 ultimately is what we're looking for in crude. Let's look at this on a weekly basis and just kind of talk through, last week. We did sell off on Wednesday along with the equities and then rallied really well with EIA and then closed above the weekly VWAP, above the 5-day, and really primed to keep pushing higher. So, the narrative this week, especially with value on a weekly basis higher. We're going to be watching 80.50 and watching the buyers really here to lean into on a push for new weekly highs. See if we can't shoot the gap towards 85. However, if we get below that, look for a beeline back to the 20-day, and that could push us back towards the year-to-date VWAP. So we'll really kind of watch that 80.50 as the key pivot. Above that, new weekly highs on towards 85. Below that, we'd be looking for the 20-day and then potentially back to the monthly VWAP in crude. All right. Typically, we like to think about any other ideas that are in focus, and one of them that I forgot to mention last week that is definitely back in focus, and that is Bitcoin. So let's jump over and look at the Bitcoin chart here, and I want to talk about. Actually, let's actually get to a Bitcoin chart, shall we? This is, bracket rules are essentially in play. What I had talked about in prior weeks was, hey, we had a balancing area that we pushed below. And as long as we stayed below that, I'm not interested in it. However, if I trade back inside of this, when you find a balancing range and the auction is unable to sustain below that, and in short order comes back inside of it, what it does is it sets the stage for it to traverse. And that's essentially what I'm doing. I'm long on the return back inside of the bracket. I'm defending against exits out of that bracket, and I'm using the year-to-date VWAP right now as a really good risk tool. But essentially, target one is going to be the top of this bracket and last year's VWAP, which gets me close to 25, 26K. Above that, if we break out and can hold above that prior bracket, then the next stop on the map is going to be up here at that next high volume node. Okay, so if we push out and come back inside this bracket, then I'll be out, right? Basically have traversed the range. And then if we break back above, I can defend as we push towards the next node, as the auction just kind of, moves from node to node. I'm not playing this as, somebody who's like, oh, this is the entry towards, 100K or whatever. I'm really looking at like, what are the most likely destinations based on the inventory? And, if I can break above here, the next place is 29 to 30K. If I can hold inside of that bracket, right? If I can get inside here, then I start thinking there's a bracket. Then I can start thinking about, as long as I'm below here, that can set me on the stage back towards 60K. And this is obviously it's going to take months. It could take the whole year to get up there. But it's this, at least this is encouraging where we are. We'll defend it to the most likely target, which is going to be up here to 25, and keep monitoring that as long as I stay above the bracket low. So that's kind of the chief idea that is in play and looking. And I'm going to real quickly just kind of pull up any other active ideas. The other one that is still in play, not looking for new entries at the moment, is the spread between the NASDAQ and the ES. This is on a 6-month basis. You can see the performance difference between the ES and the NASDAQ. However, over the last month, the NASDAQ has significantly closed the gap. So, unless I can find on a short time frame, see here in the last 5 days or even the last day, unless I can find on a short time frame where they're back to the orientation of that longer expectation, I'm staying on the sidelines and just letting the ones that I have run. Okay. So that is, kind of my chief idea there. Other than that, as we're through earnings, I kind of want to see, what specific products are doing through earnings. I did do a look at Amazon as they're getting ready for earnings here. Definitely from an inventory standpoint, most recently, this 94.33 is a key area to watch for them to push out of. They've got earnings in a week. So, could be something where I start looking at an opportunity to be long toward, 115, 120, depending on how they respond from earnings. But at the moment, really just kind of carrying forward and staying grounded in the fact that we've got, not a lot of conviction in the curve. We're kind of in the middle of the muddle and waiting for more information from earnings, watching these key releases. One other thing that I am watching here is, we'll go back here to the ES and let's look at a 120 or actually a 4-hour chart here. And all of these anchored VWAPs are all of the CPIs, Fed, non-farm payrolls since this fall. And based on the close on Friday, we're now back above all of those. We're in the CPI range from January, in the middle of it. We're not above it. We're in the middle of it, but we are above the VWAP from that. I think that that's constructive for the auction. So as long as we're holding all of these references, then, the path higher is clear. Eating through these, I think, starts to cause some capitulation that ultimately makes us hedge up and move lower. We'll get through this week, and then everything we'll be talking about FOMC next week, as well as after FOMC, we have Apple, Amazon, and Google all report on the 1st of February. So those will be kind of the next hurdle that we got to get over. Until then, we're really kind of just taking it day by day and letting this thing play out. So that's kind of the key idea that we have. Now, from a development focus, we try to spend some time every week looking at skilling up, right? And getting some new insights into what we're looking to do. And this week, what I want to talk about is how to identify and leverage poor auction structure. And what do we mean by poor auction structure? Okay, so to begin, I'm going to go and open. I'm going to go open here a little whiteboard, and we can draw about that. We can talk about auction structure. So a key takeaway is the idea that the bell curve is your friend. So when we're talking to traders on our desk, one of the things I always talk about them to look for is that the bell curve is your friend. What do I mean by that? Is that when I'm looking at a distribution. So an auction is a distribution over time. So there's time here, and then participants will act. So like, let's say that this is time, and then so this is time, and this is price. Okay. What will happen is that over time, there will be certain prices as we go that we will see clusters of participation over time. In fact, we could actually reverse this. We could say, let's make this time and make this price. Is that what we'll see is a distribution. Now, a complete distribution is very similar to like a data sample set of data analytics. If you want to do a large study, you're trying to figure out where most of the data that you're going to include is going to fall in about 65%, or normal distribution. If I have this with a statistical mean in the middle, that is a good data set. If I find that it's skewed to one side, so let's say that instead of it, being, very, bell curvy like that, but let's say instead that we're like this. Okay, not much of a bell curve. That is an incomplete or skewed auction. What that tells us in terms of trading the auction is that it's likely, so like if I've got a curve like this, it's likely incomplete. That I still have more data that we kind of stopped before we found out how this thing was going to resolve. One of the interesting and key takeaways from observations of using the market profile graphic in analyzing human behavior, because it's essentially what it's doing, is that humans act in these ways. We see this in other places too. Like we see this in a marketing adoption curve, right? So if you've ever been in marketing, that there's kind of these 4 quadrants, right? So there's the early adapter, there's the early majority, there's the late majority, and then there's the laggards, right? So whenever you put a new product out, we kind of go through the curve. And when is the product's life cycle kind of over? Is that when all the laggards are now into that. Think about Facebook as an example of users and who's involved in that. Where it started. Who were the early adopters? Who were the innovators? The ones that were doing it and nobody else was. And then over time, it matures until you got just about everybody in it. And at that point, it's definitely typically losing its luster for the early adopters. All right. So when I look at a profile, I'm always thinking about where's the bell curve. So if I look at the ES, for example, and let's go look and just isolate the TPO charts here. There are days when I've got a nice bell curve. Right, that's a complete auction. That's very helpful. Now, there's other days where I have very elongated profiles. Now, what is that telling me? It's telling me that there's not much fight around price and that auction is very impulsive. Okay, so there's kind of two ways to think about looking at this bell curve. Is that there is impulsive and incomplete auction structure, and it's predictive of future auction behavior as we're trying to get to that bell curve. So let's talk first about the impulsive or incomplete structure, and how we carry that forward in the plan. So the impulsive structure is where it's very imbalanced and trendy, where the non-impulsive structure has lots of rotations and builds around a profile, right? So Wednesday, very impulsive down. Friday, very impulsive up. Other things that we note as we look at this is, that is likely incomplete. That's why you would not take a multi-day position against a trend day, because you've not arrived at the bell curve yet. So there's likely going to be some rotation after the day where you have the big move. If I look at Friday, so I've got all of this look at ES futures. I've got all these little spots in here, and I'm going to try to somehow get this thing to equilibrium so a couple ways I could do that. I can backfill and build it out that way, or I can, keep going, and I'm thinking about a larger distribution. So that's where I can bring the composites in to kind of get me there. The other part about that is that impulsive structure, specifically when we look at things like what we saw on Friday, which is like single print. So single print is an area where we only trade that in one 30-minute period. We didn't check that. There, especially intraday, we don't often see those. Now, in a double distribution trend day, we do see those, but we don't often see them. And when we see them, it's what we call weak, impulsive structure. We carry it forward. It means that the auction didn't even have time to check and see if that price is valid. So what happens is that if we get back closer to those prices in the future, we likely clean them up. So note that from Wednesday, we had poor structure. We still have some. And what have we done since then? We've actually cleaned up and retested. Friday, we retested some of these prices. Now, what did we also do? We now have added new poor structure. So we kind of carry those forward, and then as we get closer to them, they become magnets where the auction can work to clean up. So we carry those forward. We say, hey, there's a good possibility that we're going to come back and test those later. For example, I'm going to come back to some other spots where we've had some poor structure and just see how the auction traded after that. Look at this big move here at the end of November. Massive move, lots of singles in the middle of the profile. And then look at the subsequent days. What happens? We start eating back and filling them in until we go all the way back through and completely fill them. And then we find some buyers that take us back higher. So, that's one of the other things to think about when you're looking at that. We carry forward that impulsive structure, and then you're kind of wary of directional continuity until that auction has been tested and we've accepted those prices. At that point, then I feel like, okay, now we can start going forward. So as I'm looking at what has happened between the poor structure that was here and the poor structure that's here, is that there's likely going to be some continued trade and until we kind of clean all this stuff up before we kind of figure out where our next move is. We just have, impulsivity off of a move down on Wednesday, impulsivity off of a move Friday, and we're not really sure. So depending on where we open could be insightful. If we open here, then we could go down, then trade higher and start back testing and backfilling these, and even get up here, right? And cleaning some of this stuff up until it's all cleaned and backfilled. That's something that we carry forward. So whenever you see that, and that's one of the things that you can see using a market profile graphic that you can't see if you're just using a candlestick chart. Like you just can't see the holes that are really shaky ground for the auction. And now, if I see like one area of single, I think of that as like an intraday gap, and impulsivity is a measurement of strength. But when we see multiple ones like that, it's almost too strong. It would be the takeaway. All right. So see if you can identify those in the week ahead. See if there's poor structure, and watch what happens with the auction as it goes forward. I think you'll find that it's pretty insightful in terms of what to expect in the auction going forward, and even help you get better location if you want to lean into that impulsive strength. All right. So that's going to be our team's focus. We're going to be talking about structure. It's one of the things that we cover in the modules of our development pathway, specifically module 13, which is we use the TPO to identify and leverage poor auction structure. And it's a really good thing to understand as you're building skill. On top of that, other ways that you can build skill. We talk often about the 4 questions to ask and answer before you put on a trade. Make sure that you know what those are. You can follow us and interact with us on Twitter at TradeWithProf. Schedule an insight session if you are so daring, where we just do an audit. We'll review your approach so far with the objective is to really kind of get some grit under the tires and move you forward. If you want to do some intentional development work, you can do that via our development desk through one of our pathway options. You can find more about that at tradewithprofile.com/pathway. And then for questions about platforms that you saw here, aside from TradingView, you saw edgeclear.com and windowtrader.com. Feel free to check those guys out. Finally, for those of you who are working through the pathway, I'll see you in Slack this week for our development sessions, and should be a pretty good and active week. So everybody, thanks for watching. Hope you've got some good rest this weekend. Excited for a new week ahead. So we got GDP. There's going to be that debt ceiling stuff in play. We'll be watching for follow-on from OPEX on Friday. We do have the tech earnings, and then we'll be starting to talk about the first FOMC of the year as we end the month. So lots going on. Lots of opportunity, and excited to carry forward. Thanks for watching, and we'll talk to you soon. Peace.